costs, offset your deductible costs, add some revenue, right? Which is something unique. A lot of people think insurance is just a cost, but you actually can use insurance in some cases to actually add revenue to your space. So
Matt, welcome to the show today.
hey, thanks for having me.
So we haven't talked about insurance in a while, and that's because it's not sexy. It's not nearly as sexy as raising $2 million and finding deals and dealing with interest rates, but it's super important. And, we've made some mistakes along the way. We've learned a lot. You've worked with us in some of these as well. So we want to unpack insurance real quick. Before we get going, how did you get involved to give us a little background on yourself?
Yeah, so you said not sexy, and that is normally the case. I have continuously, and Justin Timberlake helped me out a few years ago with the song, but I've been trying to bring sexy back to insurance for a long time. And
How's that been going for you, Matt?
you know what?
It's like, let's talk about asset management and operations.
Yeah,
Oh gosh.
it's still tough. It's still, battle of, is it a commodity? Is it not? Is there a partnership? But not as much sexy, but we do get into where the more we understood actually what people are going, the better that relationship has been. But to go into your question, I've been born and raised into insurance. My dad owned a state farm for 40 years, so I grew up back when, and I'm old enough to still remember Polaroid cameras, where you did, and then you had to like wave them. So that was my like 12-year-old job. Is I would drive all over. And you probably wouldn't want to do it as much today, but I would drive all over Flint, Michigan, and and no, the water was not brown then, for any of those who immediately think that, and take photos of it. So I've been doing that, and then opened a State Farm right out of college at 22. Did pretty well with that, grew that to a top State Farm nationally, and then what really got me into the real estate was I left my State Farm to build out an insurance company for Century 21. A lot of people know them. They're on the homeowner side doing real estate, and then transitioned into a love for insurtech and technology, and then that's kind of where my most recent company of Obie came, where we have a little bit of technology, but we focus our insurance on the real estate market.
And so within that, is it all insurance that you guys currently cover, or just certain kinds of insurance? Like, what's your specialty?
I say everything building, but most specifically, we are in the habitational and multifamily space. Especially my day to day is in the multifamily rental assets, from either the single family schedules all the way up to the large multifamily.
All right, so let's start with some of the maybe more mistakes or maybe false beliefs that people have about insurance. And I know, you look at, I think one of the things you do first is you look at someone's insurance policies, and you kind of identify gaps and inconsistencies. And we did that a little while ago, and sure enough, there was not only inconsistencies, but major gaps, major liabilities that if something were to happen, and not, completely impossible, the deal could go south. It was major exposure. So what do you see that, you think, is it a commodity, right? And I used to think that insurance is a commodity. I no longer think that, but talk about some of the false beliefs that people have about insurance that you've come across.
Yeah, absolutely. I think that most people watching this have probably at this point been through some type of syndication, whether they've been an LP, GP, or they're just starting to, as a student or whatever they're at, but they probably know a little bit about the space. And for those of you who haven't, it's such a rush from when you get under contract, through to that closing date. And what we've seen in the insurance space is that there's only a few things that people care about through that 60, 90 days. Well, in, normal time frame, is the price going to match what I used in my calculator or what I estimated, and not going to screw up my proceeds? And is the coverage going to meet the bank requirements, right? And there's not a whole lot of listening to me or my team, or really in general. And I don't blame it, as far as like, here's what your deductibles are, here's what your coverages are. It's like, hey, Matt, what is my per door cost? And is the lender going to sign off? So instead of kind of fighting that, we've put a lot of things in place to kind of just get people out of their own way as it relates to insurance. So we make sure that we try to hit what you need for closing. We work with the lender, which really is a fail safe as far as coverage is. They're going to make sure that you have it. And then we do an after the close call. Once you've had your celebration, you've closed, you did your Facebook posts, all that stuff, right? Then we meet with you and actually talk about like, hey, here's what your deductibles are, here's what your coverages are. Because the nice thing is we can make changes after the close, up or down or anything like that, and you can actually make more business decisions at that point. You're really constrained within the closing time frame of what the lender's going to accept and how much money you can pay at closing, right? After closing, you can start to make a little bit more business decisions as far as, oh, maybe I want to, as a general business expense, do a deductible buy down, or, maybe I do need a little bit coverage here, or I just want to adjust this. The other thing we do a lot is put in like renters legal liability type programs that help offset some costs, offset your deductible costs, add some revenue, right? Which is something unique. A lot of people think insurance is just a cost, but you actually can use insurance in some cases to actually add revenue to your space. So we do a lot to just understand what the person who's syndicating or whatever you want to call it's going through, and then getting things done so that we comply with what they want at the time. But then we make sure we go back and kind of relook at it with everybody, because we understand that, as you mentioned, things will get missed, especially when you got a million other things to do. And your mindset is like, just get the insurance done, Matt, or just get it over the finish line for me. So to kind of answer your question, that's what we do. We kind of make sure that we understand. And most of us have either done real estate ourselves, or maybe we're active investors, at my company. So we get it a little bit more than the typical broker, because we're realizing some of that stuff ourselves.
So, but why not take care of that before closing? Like, why not? Why? So, what is the issue? Explain the issue between what the lender's looking for, and to try to get the deal done and closed, and just getting it done at closing versus just getting it done and then adjusting it later. Like, why does that not work as well when you try to get everything done up front at closing, so you don't have to worry about it later?
Yeah, because I'll use examples. So a lender a lot of times will allow a $25,000 what we call AOP, or all other perils deductible, and up to 5% on, like, let's say wind and hail or named storm. Now, so that will actually meet the requirements, right? And going up to it is going to give you your lowest premium. So going into closing, that seems good. Lender is required, hits requirement. It's going to keep me from being at 700 door down to 600 door. But what I'm not thinking about at the time, right, is I have a claim, and then I got to pay out this deductible, right? And so in a perfect world, everyone would sit down with us through this procedure, and they would say, hey, forget what my cost is to the deal, but just get me the best coverage, get me the lowest deductibles you can. But what we know really happens is, they're coming up with an estimate for that insurance sometime in the process with their loan. And whatever that number is, anytime you go over it, it's going to affect your proceeds. It's going to just affect the deal in general. So it is that balance of it. And if I called most syndicators, they probably wouldn't say this out loud, but if I called most syndicators and said, hey, we're at 700 a door, you estimated 700 a door, but really, I think we should go from 5% down to 2% of your deductible. I think we should make this or whatever, but it's going to go to 800. You know what they're going to tell me? No. Let's just keep it at that 700 a door. So again, a lot of it has just been doing this for 20 years. And I just know the psyche of the individual and like when to approach them correctly. And it's not going to be an approachable conversation when, it's just trying to get to that finish line. Afterwards, people start to think through, actually, okay, how do I operate this property? And, and they're more open to ideas on getting maybe the correct coverages compared to just what gets it over the finish line.
And this is, I think, a typical mindset. And we, like I said, we used to have it. We spend a lot more on time on insurance now than we ever did before. But I think what you're saying is, why fight someone's mindset when they just want to basically, they're treating it as a commodity, right? If you want to compete as an insurance provider, then you're basically selling yourself almost like a commodity, knowing that there's going to be gaps and holes, but there's no willingness to talk about it maybe up front because they're very busy trying to get the closing across. On the other hand, though, a more experienced syndicator probably will try to make sure the coverages are correct and care a lot more about the details of that coverage. Has that been your experience as well?
Yeah, it really, it's never holes. It's more just what I call business decisions, right? Like, we're never writing anybody that doesn't have enough coverage, or it really just comes down to, a lot of times it's deductibles is the biggest key. So not really a hole. It's more just what people are not doing the math on is just, how much that deductible is going to cost if you had a claim. So the lender's never going to allow you to have holes in your coverage, right? We got to get everything inspected and go through them. They're running their replacement costs. We're running ours. So, that would never be something that we would do, inexperienced or experienced, syndicator. It's more just the little things like the, deductibles, or amount of umbrella, things like that, that you might want to adjust after. And really a lot of it too is additional programs, that will help offset some of those deductibles or add revenue. And that's really the focus. I don't want to get people off on the wrong foot that, like, oh, potentially, there's holes in the coverage, right? I think it's more just, an adjustment, and there's just a lot of constraints as it relates to the premium that we can, put on the books for a close.
So what is your process then for working with a syndicator, whether you do it before closing or after calling? And holds is probably a strong word, but you're right, it's business decisions. Hey, were you
Yeah.
aware that it's going to cost you this much if this were to happen? How do you feel about that? Like, how do you engage with the syndicator either before or after closing to make sure that the policy actually is what the partners want?
Yeah, so we provide it up front, of course, like, it's a conversation that we're having, we provide the certificates, we provide all the coverages, and then we have a full program that we do after the close. So we get on the phone call, we make sure, we know property management, we know who they want to call for inspection, who they want to talk about if something happened, with the insurance, who's going to be turning in claims. We talk about the coverages that they currently have. We talk about the deductible. So we have a program in place up front before the call. A lot of it is, just providing them the details, going through it, letting them review what they have. A lot of the work is done as well with the lender and their consultant, and going through those coverages as well. So, it's kind of the mindset too, is that a lot of it is directed nowadays through, if you have an Arbor or Bancorp deal or something like that, a lot of the insurance, we're speaking more with the bank than we are even the client sometimes. And that's just part of the process, because, the bank has one of the largest stakes, right? And they're going to do a lot for the syndication. So it's really a great thing. Syndicators should feel really good that they kind of have two parties looking at the insurance before closing. They have their insurance broker, who's going to do the best job. Then they also have the lender and their consultant, who is looking over everything and giving their recommendations. So it's overall, it's a really good process with everything that's in place.
You mentioned one consideration is getting the cost right. And so, what is your counsel to a syndicator now, as they're underwriting deals? Obviously, they don't have a live deal, so they can't get a live quote. But what can they do working with an insurance broker to try to get that estimate as accurate as possible for their underwriting?
Yeah, absolutely. So this is a good point. So we have a team that will help you when you're under contract, right? And I think what it is, more importantly, in this space, especially right now in this time, we're in a very bear market as it relates to insurance. And so most of the time when you're working with a broker and you call them up when you're going to look at a deal, they're going to throw out a per door number for you. Hey, it's going to be 600 a door because it's Dallas. And what we've really done, and this actually helps the number from, like, what I call LOI stage to under contract to closing stage, is if you can get with our team, and we provide a low end and a high end, right? And not just it's either going to be 400 or it's going to be 600. We actually do a phone call up front. We fully analyze the deal. And what we'll do is we'll talk you through why it would be the low end and why it would be the high end, and really guide that person who's syndicating when they start getting under contract. They go through, they got under their PSA, or they're going to do due diligence. We'll say, hey, it will meet this low end if the seller ends up having no losses, and it ends up being copper wiring, and it ends up being, where there's a bunch of updates. It's going to hit this high end if all of a sudden you're in due diligence and there's been 17 fires, and it's straight aluminum and this. So what we really are doing is showing the syndicator, like, hey, both of these numbers probably need to work for you, but here's how you get here. And if you want to dive in deeper, if you can get us this more information, here's how we can fine tune it. And that's been really helpful to help have the syndicator help us get to a finer, faster number, and be more accurate, right? If they never provide any of those items, those numbers are gonna be in that loose state, and we won't be able to really firm them up till later in the process. But the more of that they can find out themselves or get during due diligence or before hard money gets in place, really can help define it, and they know exactly what they're looking for. And if they want to get more details from the seller's broker to feel more comfortable, they can. So that's really what it is providing that roadmap so the syndicator can understand not just why we came to a number, but what is actually going to dictate where this goes after you go under contract.
All right, so there's a range. You mentioned there's a low and higher, and you explained what those are. Now,
Yep.
you mentioned some of those things in passing. I want to drill down on some of those, maybe what I call gotchas that drive up the premiums. So you mentioned things like copper wiring, roof or aluminum wiring. Can you talk about some of the things that that increase the price of insurance,
Yeah.
and maybe if someone sees those things, they're like, they either have to factor it into the underwriting somehow, or they might simply walk away from the deal. What are some of the things to look for?
Absolutely, absolutely. So I'll go through all the things that make it what I would call higher risk or higher, less carriers interested, which meaning higher premiums. And that is, one, flood is a huge factor that whether your location is in a flood zone or not, flood is an immediate just added expense. It's never cheap, and it's going to immediately add to your bottom line of insurance costs. Right now, the cutoff is usually like 1980, 1985. A lot of carriers interested if it's built after 85, not as many interested. Frame and before 1985 is like a what they call like a double negative, if you will. Less carriers interested. Aluminum wiring is very few carriers interested. Mitigated aluminum, you get a few more. Clearly, copper is going to be something that a lot of carriers are interested in. Previous losses is a huge one, and sometimes that's hard to know when you're submitting your bid for LOI, whether there's been losses or not. But if you do know losses from the seller will be held against you, especially right now in this market. So that's a big, stab lock is tough. So if you have stab lock on there, that's tough.
What is that? What's
Old,
stab like? What is that?
like your electric panels.
Mhm.
So I am far from what's it called, an electrician or expert as it relates to talking you through that, but I just know that the stab lock panels are older, and they are something that in the carrier's eyes have an increased risk of fire, and
Mhm.
therefore they would prefer those to be replaced. The other thing too, over 15, over 20-year-old roofs is something that they will look at. A lot of risk over 3 stories is usually another little red flag. So these are kind of all the items, and I'm sure I'm missing, one or two, but those are the biggest things. So if you have a 1975 frame, 4-story aluminum, that's going to be tough,
Right.
and you're going to put renovation into it. It's a Jim from Mad Money that just like says there's like always a bull market somewhere, and his job is to find it. Like, it's kind of like that. There's always a carrier out there for almost everything. It's just in this case, instead of just finding it and it'd be a good thing, you're finding it's going to be probably pretty pricey.
And this is important when you guys are looking at underwriting, to work with an insurance broker up front. So when you're looking at something like where roofs are 3 stories or anything like that, you got to factor it into your underwriting, right? Otherwise, you're gonna get a pretty big surprise. Now, like you said, one thing that you won't probably know up front is previous losses. And I thought that's a big factor, and this is one of the things you uncover during due diligence, right? And you can't really uncover that before. If that is a material thing, I don't know how many sellers disclose that, but I don't think very many do. But it could make a
Yeah,
material difference.
yeah, and absolutely. And again, there's more people on this and yourself that are experts on the real estate than me. But when I look at it in a perfect world, the more I can get into the contract or the agreement to make sure that they're providing, at least when you do go under contract, that they have to provide you updated loss runs, they have to provide current
Right.
policies, right? Even if there's some contingencies on there, I've seen a lot lately where when we find out about that huge fire loss, right, the impact it has to the insurance, and then syndicators are trying to go back and retrade or, negotiate then, again, I don't know if these are things that can be done, but just thinking from the insurance mindset of like an ideal situation, if you could have something in there, especially when you're about to sign a contract that says, which would red flag, and I would assume that they would bring it up before they would sign it, like, hey, if we find out once we go under purchase here that you had some $1 million fire loss or 500,000+ fire loss that's going to cause us insurance, like we're going to need to immediately chat, right? Because, and again, I don't know if that's possible or not. I'm not the real estate expert, on the call, but those are real things that are happening where people are getting under contract. They're thinking, this has no losses. We kind of estimate it based off of having no losses. And next thing you know, we find out that there was, $2 million plus fire losses. And instead of it being $400 a door, it's $1,200 a door. And that's huge to the NOI, right?
Yeah, it is huge NOI. It's one of those things you can do during the financial due diligence phase is to request those things as part of the documents. And like you said, it's a material issue, kind of like in discovered economic vacancies and that kind of nature. It's as big as that for sure. So that was good. So guys, pay attention to that when you're doing due diligence as well. Now, one thing we deal with, obviously, is once you bind the insurance is an increase in premiums, and it almost seems like premiums are going up and there's nothing one can do about it. What can an operator do to kind of manage this seemingly unstoppable increase in premiums?
Yeah. So again, I'll speak on both sides, insurance side and real estate side. So starting with the real estate side, clearly, you're going to do all your stuff as far as increasing rents and drive revenue. But one thing is there's rental programs that you can put in place that is an insurance product that you can provide renters insurance to your tenants, and then actually charge a delta that you make up that you can either use to offset insurance costs or offset your deductibles. So that's something on kind of the real estate side. And then from the insurance side, just like anything else, of course, yes, you're going to have the increases. I think where people run into the issue is two ways. One, make sure you have a broker who actually really will look at it every year. Every broker in America will tell you that they look at your stuff every single year and they shop it. Maybe they do, maybe don't. All I can speak on is you really want to have someone really looking at it, and then you need to equate for it. I think so many people are just afraid to. They equate for increased lawn cutting costs. They equate for this all in their 5-year projections. But for insurance, they'll put some like crazy number, like it's only going to increase 1% each year or 3%. And that's just not realistic, not in, what I would call tougher markets. Now, if you wanted to over 5 years say, hey, we're going to have 2 bad years where I might get a 10-15% increase. I'm going to have maybe 1 year where I stay neutral, and then 2 years where maybe we're sub 10 or sub 8% increase. I think those are fair to kind of look at it in like a 5-year cycle. Because you even look back from like 2017 through now, 2017, 2018, 2019, I thought insurance was cheap. I was almost afraid to give some of the rates we were giving because I was like, oh man, this is almost too good to be true. And, now people are seeing it. And then you look at the last couple of years and it's been like, whoa, right? And it's just been like a big increase. So you even look over that span. If you were back in 2017 buying an asset and you would have said, hey, 2 good years, 1 medium year, and 2 bad years, and projected that accurately, either even across or, kind of just notice the market that you're in. And these are conversations you can have with your broker of like, what type of market are we in? When do you think we're getting out of it? Are we getting out of it? Adjust. But I think a lot of people, that's where we see is they going into year 2, they hit us up a few months before when they're projecting out what insurance might cost, and we'll come back and say, hey, it looks like you're going to have an 8% increase or 7% increase, which is not terrible. And they're like, well, we projected 3. Like, what happened? I'm like, what I mean? And so I think just being accurate with your projections and working with someone, again, the focus is always so much about getting to the finish line. And I think people forget about the next 1, 2, 3, 4, 5 years, whatever you're going to hold the asset. And that's not just with insurance, but that's what I've just seen in general, being around purchase after purchase, operator after operator, is 99% of the thought is just, how do I get this thing closed? get investors to, raise capital, all those items. And you forget that like actually the hard work starts after the close, operating it, turning capital, making decisions, that's really the key, right? And
Yep. That's really good advice. What's a good increase that people should use in underwriting, you think, for the next 5 years?
I think if you want to be conservative right now, asking this question, I would conservative around 9-10%, aggressive being 6-7. In a better market, you can probably shift that down to 3% there. What we've done as a brokerage, and we've been pretty accurate, is we've tried to high end this year keep everybody less than 15. Uh, Goal was to shoot for 10, and then if we got you under 10, it was fantastic. And that's just being real. Like that's the market we're in. But a lot of times we only got those numbers where switching to a different carrier or finding a different avenue, because I'll tell you, most of our renewals, like the carrier actually that was renewing this year was 25, 30, 40%
Mm.
actually on the renewal. So we've had to reshop and rework stuff here in 2022 more than we ever had to in, let's say, a 2019 or 2020 when things were just renewing. But again, that's just part of part of the business. So this year we actually had to add staff to handle just our renewals, because it really is crazy numbers, and we're not someone that will just try the whole like, oh, you're a client, you closed with us last year, we're just going to wait till 3 days before and stick you with a 40%. That's just not how we do business, on things. And so, yeah, I think that's really the key is one, having, again, the broker who is going to really work on things for you. And then two, sitting down with that broker, maybe in that 2 week after the close conversation is a good time too, of like, all right, let's really talk through the next 5 years. What does this look like for me? As an operator.
What do you kind of see as an outlook from an insurance perspective for the next 5 years, or what's going on right now? Are there certain developments that it's going to affect insurance one way or another?
Yeah, absolutely. So this is probably one of the worst markets I've seen in a long time, just being frank. But it's just like the stock market or anything else, right? Like the whole country's in a bear market right now. Like what's not having a hard time, right? And it just seems like the moment that this is how bottoms are created, right? The moment that everybody's just kind of given up, fed up with, where things are, is when things rebound. And so how that works in the insurance space is why things start to get bad is a couple reasons. Carriers go under, which has happened over the last 2 years. Carriers decide they don't want to have business anymore, which has happened. And then last is hurricane or major catastrophe. And we just had the fourth largest hurricane on record in Florida, about 10 minutes actually from where I live. So we've had everything hit. Mix in a once in a lifetime crazy pandemic that kind of just messed up rates and kind of screwed with carriers. And that's where we're at today. Mixed with the last thing of just a bad economy in general. And that's why you're seeing all time just like poor rates right now. So where I'm at is I think that'll continue through the rest of this year. Of course, I think we'll see it pretty heavily into 2023, but I am optimistic that starting maybe summer on, August on, if we, don't have a crazy cat year, we could start to see a little bit better going into late 2023 into 2024, because eventually it happens with stocks, happens with everything. Carriers carriers start to come back in, more carriers get created. Carriers start to like, hey, you know what? It looks like there's some opportunity in this HAB market. We got, so it's all in a cycle, right? I call it a 5-year cycle. It might be 6, it might be, 4, but roughly it's a thing where you have the same thing. Bad storms, carriers get out, carriers go under, then certain carriers make some money, because they write their ticket as far how much premium. Eventually other carriers are like, oh, I'm going to go compete with them, and they get in. But you see it the same in real estate, right? It's there's buyer market and seller market for a reason, right? And they kind of, rotate depending on certain factors, right? From, like right now, you guys are interest rates is dictating a lot as it relates to real estate. Same type of factors that you can relate over to insurance. It's just, different pegs, different holes.
Now you're with a company called Obie, Obie Insurance.
Yes.
How what kind of real estate investors or operators are you looking for? Like, give us an idea of the type of real estate, the size of the real estate. Is there a sweet spot that you have? Who's kind of your
Yeah,
ideal operator?
absolutely. I think our sweet spot, or just who we work with most, I'll put it that way, is people usually in the like 50 units to let's call it even 400 units. A lot of times it's 50 to like 200 seems to be the sweet spot of the size, and that's per apartment complex. We also work really well with people who are new in the space, or groups that have like students. The reason for that is we're set up for like kind of the hand holding, we're set up for the education. Because we have the fortunate opportunity to be like VC backed on part of our company, we can spend more resources to assist in times of like underwriting, helping through the under contract, where a lot of brokers like they have to see ball and they have to hit ball to pay the light. So yeah, so our focus is on usually people who are newer in the space or just getting into it. And then overall, say people who want to add a partner to their team, we really work better in that space. If you're someone who's like super aggressive on rates and wants to have two, three, four brokers like shop it out and go, that's probably not the best fit for us. If you want someone like that, you like having a lender, you like having your property manager, you like having your asset manager, and you want to add like I like having a guy or a gal on the insurance side, that's where we really fit in. And over time with that method, I'm able to do a lot when I have a continued customer that we work with, to help get people to closing, help them with rates, help them with increases, even if I have to do some things on my end, to help them there. And I can do that when there's an established relationship. When it's just, a one-off or this or that, it's harder for us to work in those situations.
Yeah, I love it. That's really what all syndicators need on their team is they need a partner they can do deal after deal after deal with. So that's awesome, Matt. How can people connect with you and find out more about Obie?
Absolutely. So you can email me, Matthew at obrisk.com, or you can go out to any of the social medias and look up Matthew Sutika, Sutika. And would love to help you out. Clearly, you can go to obrisk.com and get a hold of me there as well. But I love email, and I love the social media to connect.
Awesome. Check out Matt here at obrisk.com and schedule a call with him and see what you guys can do together. Matt, it's been great to have you on the show here.
Hey, thank you so much.